Alright, guys, so we have a lot of ground to cover today. We're going to talk about China's big dollar short. We're also going to cover the stock meltdown isn't over yet. Plus, the US has this crazy sovereign wealth fund idea that's only going to backfire. Now, by now, we know China wants to break away from the dollar. They have seen the Russian reserves get confiscated and their banks, they're getting threatened almost every month. However, breaking away isn't easy, especially when doing business with the G7. China is the world's biggest exporter, and through trade, they are earning a ton of US dollars. China's trade surplus in 2022 was over $850 billion, and this year is going to break through a trillion easily. De-dollarization is going to be a long-term process, guys, and in the meantime, Beijing still has to manage their huge reserves of dollars. The Chinese economy is to a large extent manufacturing and export based. They need to carefully manage the strength of the Chinese RMB, which means fighting against the crazy moves of the US government and the Federal Reserve. Every time interest rates fly to the moon in the US, China's currency gets hammered. Understand the enormous pressure China's central bank is under. There's the real threat of asset confiscation and the risk of US dollar sanctions. And now there's monetary policy as well. And that's why China is using their state owned banks to fight against the US dollar. China has mobilized the banks to short the dollar by an amazing 100 billion. In fact, estimates put it as high as $400 billion. And once you understand this, you truly see how complex the Chinese financial system really is. They have many levers to pull, and Beijing is enlisting their national banks to suppress the dollar. So, how are the banks helping to support the currency? The mechanism, well, is very simple. The state owned banks use currency swaps, and their volumes are exploding through the roof, hitting over $300 billion in August. The bank swaps Chinese RMB to traders and investors in exchange for US dollars. And here's what the bank does with them: they go out into the spot market and they buy back the Chinese currency. And this is a bet they would probably win, because what is happening over the next 2 years? The Fed is going to cut interest rates down, the dollar could weaken and depreciate fast over the next 12 months. Chinese banks could be the big winners here, earning a ton from those swaps. They will be paying back in newly depreciated dollars. And that's a very big reason why they are willing to help the Chinese government, because the fundamentals favor this trade and the government has a mountain of reserves to back the banks up. Now, there's no smoking gun in this trade, but China is probably outsourcing their currency intervention to the banks. This allows Beijing to better use their own currency reserves than to fight an endless battle with the US dollar. They can invest more in emerging markets, they can build stronger supply chains and subsidize their industries further. But why all the cloak and daggers? Why is Beijing doing this? Why are they being so covert about this? The problem once again lies with the US and their never ending threat of sanctions. In 2019, the US Treasury named China a currency manipulator, and that's after the PBOC devalued the RMB after the US started a trade war. So it's really the pot calling the kettle black. Being labeled a currency manipulator, considering US China relations today, is very, very risky. You could be slapped with sanctions and even more trade tariffs. Managing their currency is extremely important. China is still juggling a property crisis and trying to boost domestic spending while maintaining competitive exports. In the first half of the year, China's domestic consumption accounts for 60% of GDP growth, and that's the bar in black. Exports contribute around 14% of economic growth, and that is in yellow. Beijing needs to boost local consumption because the trade war with the G7 is starting to escalate. And to make that happen, the Chinese yuan can't fall too much. And that's why currency management is extremely important to China. They need an outlet to strengthen and weaken the RMB whenever they want. Now, during her trip to Beijing, Yellen made it abundantly clear that China's industrial policy is a big threat to the G7. Chinese goods are just too good and they are just too cheap. So the only way left is to punish their exports.
Now, we're seeing an increase in business investment in a number of new industries targeted by the PRC's industrial policy. China is now simply too large for the rest of the world to absorb this enormous capacity. Actions taken by the PRC today can shift world prices. And when the global market is flooded by artificially cheap Chinese products, the viability of American and other foreign firms is put into question.
In 2025, either Trump or Harris will be elected, and both candidates, to be honest, they are just a headache for China. But for the Chinese, a Trump win will be even more painful for their exports. And this will put enormous pressure on the Chinese yuan. Despite the crazy rhetoric of China being the boogeyman, US China trade reached nearly $650 billion a year. Just in exports to the US, China did $450 billion in trade. If Trump slaps a 60% tariff on Chinese goods, this could destroy trade completely. In the short term, this would spike the US dollar up and cause the RMB to plunge. There will be less demand, at least in the short term, for the Chinese currency. And if China doesn't intervene, the cost of their imports could fly to the moon. And that's why Beijing needs the state-owned banks as an outlet to manage their currency. If the RMB starts to drop, the banks can borrow dollars and buy back the RMB without draining the central bank reserves. But let's pivot a bit and talk about the US economy now. We are entering the twilight zone because the Biden White House has conjured a truly bizarre economic plan. They're considering creating a US sovereign wealth fund. Even Jake Sullivan is amongst the people drafting the proposal. Now, you might be wondering what's so wrong about that. Many countries around the world invest their state funds for returns. In 2023, Norway came in first with nearly 1.4 trillion under management. China is in second and third place with a total of 2.4 trillion. Saudi Arabia also have their own wealth fund of $700 billion. However, there is a fundamental difference. The wealth fund of China and Saudi Arabia, for example, are funded by their surplus from global trade. The money is coming from the Saudi oil exports, and in China's case, their wealth fund is from their industrial profits. The US doesn't have a trade surplus. They have a massive deficit every single year for God knows how long. There isn't any excess cash you can accumulate to build up their pot of investment. The former Treasury Secretary basically called it a crazy plan. It's one thing if you're Norway or the Emirates. They have this huge natural resource to accumulate a big wealth fund, but we've got a big budget deficit. The US is already in a horrible debt crisis. Raising money for the US sovereign fund will obviously come from borrowed money. Janet Yellen will have to issue a ton of bonds to raise trillions more. The idea, of course, is to counter China's global control of supply chains to help finance US companies to compete with Chinese firms. In other words, wage a subsidy war and investment battle with China. However, there is a problem called the national debt. Even if the Federal Reserve cuts rates by 1%, the daily interest payments will still be $2.5 billion. Imagine if the US decides to raise more money for the wealth fund. This will take the national debt to 40 trillion, maybe even 50 trillion easily, which will just result in even bigger interest payments. That is the consequence of this crazy idea. A sovereign wealth fund is basically one big excuse for the US government to borrow more money and spend it elsewhere. It's a disguise for another Inflation Reduction Act 2.0. The US deficit already stands at 6.3% of GDP. Raising $1 trillion will balloon the amount to 10% of GDP. And unlike China, you aren't playing with house money. You are borrowing money at 3 to 4%. A better solution would be to just simply stop spending money on all these useless programs. Reduce the size of the US military and channel the spending elsewhere. Now, I put this scheme on par with the crazy $1 trillion platinum coin. A wealth fund sounds really smart on the surface, but because of the existing debt burden, it would only backfire. It's not feasible. And speaking of trouble, let's now talk about the stock market meltdown. Now, in August, we saw a 10% collapse. and in this month alone, we face a mini wipeout in the S&P. In the first week of September, the markets destroyed $2.2 trillion in market cap. The labor market is in crisis, vacancies spike higher, and layoffs are increasing. And everyone is expecting the Fed to act aggressively. In other words, we could be getting an emergency cut of 50 points. The US economy isn't doing well. The recent jobs report shows an increase of 140,000 jobs, but even that too missed the estimates. If we zoom out and look at the totality of the US labor market, we can see a bloodbath across the board. There's no denying this anymore. Payrolls in the US are clearly trending down from an average of 500K to less than 120K per month in just 2 years. Broad unemployment is also at its highest since October 3 years back. It's hovering at just below 8%, which is horrendous. This is a clear sign that even with massive government spending, the US economy is weakening fast. The screws on the Titanic are starting to come off. For all we know, we might already be at the start of a recession. Let's not forget that it takes the NBER forever to declare one after the fact, sometimes up to 12 months, even 21 months. And this is bad because there are two different paths for the markets once the Federal Reserve starts to cut. We have, of course, the fairy tale landing where everything is fine and dandy. The other scenario happens when power cuts into weakness, when we are already in a recession or at the doorstep of one, and that's when the markets melt down completely. Since 1929, every time the Fed cuts rates, it tends to be positive, but that's only when the economy is resilient and strong. It rises by 18% on average. However, cutting into a recession can see the markets plunge by almost 18% as well over the next 12 months. The fall that we saw last week could just be a prelude to a much bigger correction depending on the data. We still have two big news coming up before the Fed cuts rates on the 18th of September. CPI inflation and retail sales, especially retail sales. If we see weakness in the retail sector, it will just confirm the worst, that economic weakness is real and is starting to spill over into the real economy. A bad retail sales report next week could be enough to spark another market collapse. Bad news will really be bad news this time. We have to consider the true weakness of the US consumer. The 1% retail growth in July is supported by a mountain of credit cards and delinquency rates are rising. When more people start losing their jobs, the floor under the retail sales will just fall off. The incoming August number could be really ugly. Companies are announcing the biggest jobs loss in the last 6 months. According to Challenger, US companies have announced 76,000 job cuts for the month of August. That's a 193% jump from the previous month. When people lose their jobs, where are they going to find the money to spend, especially in discretionary? It's going to go into rent, food, and gas, and even that will be scaled back. The retail print this month could get walloped. And where are the majority of job cuts coming from? They are from high paying technology jobs. Almost 40,000 jobs were cancelled in August, the highest in nearly 2 years. Just look at the big spike. So it's time to brace for impact. The Federal Reserve, they are cornered. If they don't cut rates down aggressively, it will drag out the economic damage. But if they do cut 50 points or more this month, they are essentially admitting to a recession, and that could be enough for the markets to plunge even further. We are in a no-win situation here. But let me know what you think. Will China continue shorting the dollar? And is a recession coming for the US economy? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.